All right. So, hello, everybody. Morning, afternoon, evening, wherever you are. Welcome to F.A.C.E. This is going to be a relatively brief show today because it is the day after Thanksgiving. Happy Thanksgiving to all our American friends. And I think it's Steve and myself just going through a few things that happened today and yesterday. It's been very quiet, but we are here for you just to round up the main events. So, Steve, are you here? Just checking. I think you are. Yeah, I can see you. Okay. Oh, Kman's here as well. What the hell are you doing here?
Yeah, I'm here.
Anyway,
just in case you need me.
That's fine.
Hi,
So,
Hey, Stel, I'm here as well. Just give me a couple of minutes.
Cool.
Okay.
Cool.
Thank you.
Yeah. So, just a brief round of what's been happening. Last show we had was 2 days ago. So, we had the FOMC meeting minutes, and they were taken by the market as being on the dovish side. We had a number of members favoring a reduction in the rate of rate hikes going forward. We kind of knew this is coming. They're always going to reduce the pace. The question is by how much and where. More importantly, is where is the terminal rate? And at the moment, Fed Fund futures are pricing a roughly 5% terminal rate, and we are expecting a 50 hike in a couple of weeks' time. If they do hike 50, then it's another 50 or so, or slightly more, and then we're done. Is that the case? I'm not sure. But anyway, in any case, the markets like this. Risk kept getting bid. We've been saying for a couple of weeks now, maybe more, that in the absence of any major announcements or data or anything like that, the markets will probably continue to grind higher in risk and lower in the dollar and in rates. And this is what we've seen. So yields yesterday was the market was closed, and actually the fact that the US market was closed makes this look better because rates were dropping yesterday. The bonds were sharply higher in price, but now they're reversed. So in this chart here on the daily chart, you can't see it, but it would have broken below this 64 support. But as it looks now, we've talked about this range around here in the 60s being strong support. And look, we have bounced back from that. So going into next week, remember next week we have Jay Powell speaking at the Brookings Institution. He's going to be talking about the economic outlook and the labor market. So there is a good chance that he's going to mention monetary policy and rates and rate hikes and all that. Maybe he won't, but I think there's a good chance. And let's not forget, Jay Powell, with pretty much every chance he's got, he has disappointed markets. So will he continue to be on the hawkish side, or rather more hawkish than the markets expect? I actually think so. I've said it before, I think we have one more disappointment, one more push, lower in risk, higher in yields, higher in the dollar, and then first quarter of 2023, it's all over, and we begin the big U-turn and the big pivot. But until then, what do we think about the markets? Well, I think that the more rates go lower and the more the dollar goes higher, and the dollar goes lower, the better the risk reward is for taking a counter trend view. So if you look at the DXY, we're looking at this on the flow show this morning. Actually, we can look at the euro dollar. It's easier to trade as well. We are at a level which I've noted the zone ages ago. It's a zone of interest. We are there. We have the 200 DMA. We have these previous highs. It's all kind of confluencing here for a move. The question is, do we break out higher or do we break out lower? Break down lower. If we break out higher, that means that Powell is not hawkish. And if that happens, I think the door is open for a larger move higher, possibly towards these highs of 108. 107.5, 108. But I do think that we're going to get disappointed. So as a trade, I'm going to be very interested. This is, I think, for me, risk reward short is looking good. Also because the market is just getting a bit ahead of itself, as it always does. Market always tries to kind of price in all the good stuff, the good news as early as possible. I'd be a bit careful being short the dollar here. As I said before, though, if we do break these highs, then that means that something material has changed in the macro environment, and I wouldn't try to go against it. Either way, I think the risk reward is good, and you know where you're wrong. If you short your dollars, you know that you're wrong above these highs. So this is what I'm going to be looking at, and I do think that we're going to grind towards these levels here. And if we do,
and by the way, Stelio, good morning.
Yep.
Sorry, I'm back.
Morning. No problem.
By the way, I was looking for quite some time now one more low in the dollar and one more high in equities. We got the one more high on equities, and we got one more low in the dollar on a daily closing basis. So if somebody looks at the Euro USD or the DXY, we did not get a new low having to do with, because of that spike lower we had.
Yes.
Yes. But on a daily closing basis, which is, a lot more important as a market indicator, we did actually get a new low in the dollar, in the DXY. We did get a new high in the Euro yesterday, specifically. We did get a new high in the Aussie. We did get a new high, and that was a comfortable new high in the cable. So in many of the popular FX pairs, we did get the dollar producing new daily closing lows, right? So I agree with you. I do think that we're now, especially considering the risk reward, very nicely positioned to, to perhaps even start moving in the opposite direction, right? I would definitely not chase these moves anymore in the direction of dollar weakness or equity strength, right? Yes, we can see more of it, but I don't think it's, I think it's not smart at all chasing here.
I agree. And like you said, these daily closes, new high in the cable, new low in the DXY, they can kind of carry with them people who say, "Oh, right, this is a new high. We're breaking out. I have to get in." So they kind of suck in new positions, and I think that the risk is more and more that we get reversals. But obviously, this is going to depend on Powell and on what we get from that side. One thing to note, data-wise, today we got CPI out of Japan, and it was stronger than expected. So the headline number 3.8 up from 3.5, and they're still at negative rates, aren't they?
These guys, I think
Yeah.
they're sweating bullets, honestly.
Yeah,
and
even core is higher. Yeah,
because
yeah.
I've said it before. They formulated a monetary policy since Abe that it's a Roach motel. There is no exit. You know what I mean? And if inflation becomes sticky, they don't have an exit policy without literally going through an amazing financial crisis.
Yeah,
I agree.
I think Kuroda is living a happy life in Hotel California, no?
Yeah, true. Anyway, we are seeing...
Steve, speaking about Kuroda, there is no wage inflation in Japan. The Bank of Japan governing council only gets 0.4% increase in wages next year for folks. And I think that's why Kuroda is so pissed off that he doesn't want to change monetary policy.
Yeah, the fun part is I think that economics is probably the most abused science out there, right? Because it is a science, it is a social science, right? But it is a social science that also includes, quite a lot of mathematics, statistics, depends on what you want to do. One of the more prominent abuses having to do with the understanding of economics is the flawed, extremely outdated, proven wrong understanding and belief that wages is what drives what we call inflation with the recent with the more recent definition of the word inflation, right? Because inflation used to mean the expansion of money supply. Now it means an increase in prices. And I've explained it before. It's a very simple concept for people to understand. Inflation is a monetary phenomenon. When we have inflation, we have the erosion of the purchasing power of a currency. And that makes all prices go up against that currency. And guess what? Wage is a price. It's the price of labor.
Exactly.
It's as simple as that. So of course, it is getting affected, and with a lag, usually with a lag, because anybody that has actually worked in real life for an employer knows that nobody can knock the door of the employer and say, like, something, my economic projections say that inflation is going to go up during the next few months. So I want us to discuss in advance how we're going to be adjusting my wage as inflation grows if I'm right. Nobody's going to do that. Yeah. You're first going to see inflation go up. And if it goes substantially up, sometime it's going to pass. And then you're going to approach your boss and be like, something, I don't want to be a pain. But you've seen what's happening with, inflation, etc. I would want to readjust my wage to at least, not be losing purchasing power. But that is a procedure that takes time. And many companies are going to be like, something, sorry, I would be more than happy to do that. But I can't do that because due to inflation, our costs have substantially increased and we don't have the ability to pass all of them to our clients. So we are actually in a worse, financial condition than we were before inflation started. So sorry, we would love to accommodate you, but we can't.
Yeah.
Okay. Anyway, a couple of other things to mention. We got German GDP slightly better than expected, and the consumer climate slightly worse than expected.
I don't want to be a conspiracy theorist,
but you are.
No, I'm not. I've kept repeating I've kept repeating myself multiple times. I think that any person that is objective realizes that inflation is not what's being reported around us.
Yeah, we can see that.
If you consider, and I've said it before, that the calculation for GDP always finishes by taking the reported inflation, so you can deflate the current GDP reading to the prices of the previous GDP reading, so you can actually compare apples to apples, right? So we can understand that if for some reason you believe, I do, that inflation is underreported, the methodology to calculate inflation is created to underreport, you can understand that that underreporting multiplies the higher the actual inflation number is. The effect of the underreporting increases, right? As the inflation is higher. So consider me a skeptic. I believe that we've seen a positive third quarter GDP out of the US, out of Germany now, etc., etc. Personally, I believe that we're still in a recession. If we actually ended up deflating GDP by a proper number that depicts the actual inflation, GDP would still be deeply negative. That's my opinion.
Yeah, I don't disagree with that, actually.
I agree.
So, yeah. Anyway, bottom line, back to markets. We are, I guess, as I said before, we're still grinding. I mean, if you look at the S&P, we've been talking about 4050 to 4100 being kind of the big resistance zone to look at.
And look at the 200 DMA, yeah?
Yep, we're almost there. We might not get there. I mean, we're talking about this for a while, and we've arrived. Obviously, the big event is next Wednesday. Let's see what happens. But until then,
yes, theoretically speaking, until then, there is room for these moves to extend. But as I've been saying for a couple of weeks now, I think that so many investors have been burned by being optimistic about the message they're going to be receiving from the Fed during the past 5 months, 6 months, whatever it is, that I'm assuming that some of them will be smart enough not to try to chase their luck, until the day before.
Yeah, and especially after this move and coming so close to resistance, it doesn't make sense to be definitely not initiating longs here, I don't think, and starting to become attractive to just like with the dollar to look at the counter trend trade.
For me, the next Fed event is going to be probably the most critical one for this cycle. And I'm not a person that says that for every number or every announcement or every statement or every monetary policy decision that we get. The reason I'm saying that is because we've seen a reversal in the dollar. I've said that before. We've seen a reversal in the dollar that was decently strong, right? Despite Powell delivering a hawkish message. So we got an initial reaction that was in par with what Powell said, but that initial reaction within 24 hours had been retraced, and we got the dollar weakness, so on and so forth since. Now, if we get, I think there is a very high probability that Powell is going to be rather hawkish again. He's going to be saying again that, listen, yes, we're happy that inflation seems to be going down, but it's extremely premature to declare victory, blah, 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 blah. So if we assume that he stays on course and delivers the message, that type of a message, but the markets fail to actually reverse, then for me, that's going to be a huge pointer in the direction that perhaps the dollar has topped. And I'm going to start seriously considering post that to switch after many, many, many months that my mindset was we should be buying dollar dips to we should be selling dollar rallies, right? That's why I consider this event to be extremely important, because I want to technically monitor how the market is going to react to it. Now,
and
if we get the dovish,
you're talking about the Fed rate decision, right? Yeah.
Yes. Okay. And Powell is going to lead to that. You know what I mean? I mean, he's going to speak. He's going to lead to that. He's going to probably give us a good, a glimpse of what to expect. Now, if we get a dovish message, then the chances are very high that we've seen the dollar high. If we get a hawkish message and yet the market fails to make that, to materialize that in price action, I will again believe that we're probably seeing the dollar high. That's why I consider the next Fed decision probably the most important one in this cycle, right? It's going to either confirm that the trend remains dollar higher, equities lower, or the opposite.
Yep, I agree. Anyway, we're in a holding pattern now until next week, and then until the 17th of December when we have the FOMC. But let's see what happens. I don't know if you want to show any charts or anything.
I'll absolutely grab the.
Yeah, can I just say it's a big data week next week as well, right? We have to take everything into combination one with each other, in my opinion. The Powell is one thing, but then we are going to have PCE, we're going to have the jobs report, as we've been saying for many times, those job reports could be lagging the rest, and finally, perhaps on this one or the next one, starting to show weaknesses. The market will be keeping a close eye on all the data as well, in combination with what Powell has to say next week.
Yeah. As I've said, for those that haven't listened to it, I'm going to be very brief, and then we're going to go to the charts. The best path forward for those that are bullish risk is economic weakness, but not too much, right? Not some kind of a very, very deep recession. So some kind of a recession that's not going to be wild, that's going to help bring inflation even further down, and it's going to be just enough to get the Fed pivoting sooner. That's the ideal scenario for the bulls.
Weaker numbers, but not catastrophic numbers.
Yes, yes.
As I've been saying many times as well on the Flow Show.
Yes, exactly. That's the perfect path forward for those that want to be bullish. Catastrophic type of huge recession or economy that's going to be doing good with inflation remaining high, neither of those is going to deliver a Fed pivot that people are looking for to go, crazy once again and start buying every junk out there, hoping for multiple expansions. Anyhow, now a few charts. Euro USD has been stalling at the previous high, right? We've already shown that. The S&P has stalled at the 200 daily moving average. As Stelios was showing, there is some more room to the upside to find these descending channels, trend line resistance. Look at the cable though, right? The cable has overperformed the euro, as you see. But, I'm monitoring this area of resistance. Notice, let me zoom in. Notice, this is a possible ascending wedge, right? 3 points already that this trend line passes from. This is the 200 daily moving average there, right? And RSI has stalled without having reached overbought levels. So, I think this is a really nice chart to look at. Dollar strength is definitely going to technically make this a beautiful rejection from here, right? Now, look at the Aussie. This is the path forward that we had envisioned some time ago. So far, it has been playing out perfectly. Now, as I was saying before, right, we did not create a new high. We haven't completed yet the inverted head and shoulders formation, which completes at 68.5 practically. But we did technically register a new high by closing at a new high. Now, is that going to prove enough? We're going to find out. For the time being, there's no solid evidence for sure, right? Look at the DXY. DXY finding support at this support resistance level again, has created a new low in a daily closing basis, a couple, 2, 3 new lows actually in a daily closing basis, two, and perhaps today is going to be the third one, depends on how we move on the day. This is what I envisioned some time ago, that we would break through this pennant and perhaps, have one more low. Notice the 200 daily moving average is converging to this area of support. It's very, very close. Dale would say close enough for government work, right? Now, crude oil, notice how it has been finding support at the same area again. Now, admittedly, crude needs to do a lot more to prove that it's turning bullish than potentially be forming a double bottom, right? I was saying the other day that the back test, I remember I was on the webinar and we were back testing this broken double tops trend line support as resistance. And I was saying that, listen, this is when we drew these two lines. I said, listen, this is from a risk reward perspective, a great area for somebody to be short, because we're back testing and we're either going to be confirming this double top or we're going to be invalidating it. We actually got rejected from there. We had a beautiful, strong move lower again. Despite all that, we haven't managed to break to new lows. We back tested a few days ago the lows with that spike lower that we had. Nothing more than that. As long as we trade below 82.5, you can be bearish. Now we break through 82.5, the waters are going to start being more muddy. We break through this descending trend line resistance, and then we should be turning bullish. As simple as that. Silver, still within this ascending channel, toying around with the 200 daily moving average. As I've explained before, I'm going to be taking my cues off gold. And why is that? Simply because gold is technically cleaner and easier to read at the moment, right? We had triggered this triple bottom. We back tested these triple bottoms resistance twice. I know that it doesn't look really good in the short term gold, but I can't really go against this triple bottom as long as we don't break back below it, right? So as long as we trade roughly above 1730 on a daily closing basis, gold might make another move to the upside. Now, if it ends up breaking through 1730, then once again, we stay in a situation that, we know we're in some kind of a prolonged corrective move. The long-term outlook still looks very bullish, but the short-term outlook is going to go back to neutral towards bearish once again, right? It's a matter of time for precious metals to start exploding to the upside, but that doesn't mean that you should want to front run this unless you want to invest in them. If you want to buy them and hold them, fine, it doesn't make any much of a difference, right? Now, you want to trade them, though. A trade is something that has to have a specific target, or at least a first target, a specific stop loss. You have to formulate a plan and know in advance, where am I wrong, right? Because if you don't have a specific stop loss and you start praying when it goes against you, that's the most certain way to go bankrupt. Sooner, later, it doesn't really matter, because eventually you're not going to escape. If you're trading this way, you're not going to escape getting your trading account to zero. What else? USD yen. Now, I ended up hesitating to close it, and it worked in my favor. I was looking at it yesterday when it was testing this line. I hesitated to close it for a profit, so I'm still in it. Perhaps I should have taken profits yesterday, but I was thinking that I should also have taken profits up there. I'm still not convinced we've seen the low here. We might not. I'll probably wait to see how things are trading on Monday and reassess. I have the comfort of being very, very deeply in the money, and that gives me the ability to be a little bit more relaxed and hesitant with where I want to take my profits. It's half a position anyhow, as you know, those that monitor. So I don't know. On one hand, I want to capture another leg lower if we get one. On the other hand, I don't want to give too much back to the market. I don't know. I keep thinking about this position every day. I don't know. I'm going to let you know once I end up closing it. I want to see what happens on Monday. If on Monday I see another move higher here, I'll probably take profits somewhere there or whatever. If on the other hand, I see it being under pressure once again, I'm going to do so. I've already put on my trading account, though, a stop loss, a solid stop loss, which I didn't have for quite some time, above this recent high that we had. So, I'm not going to violate that. If for some reason we retrace or we spike above that, I'm automatically gone, right? Until that happens, I'm going to see. Probably I'm not going to wait for that stop loss to be hit. I'm going to manually close it, but we're going to see. Now, all that is on the back of what is happening with yields, obviously, right? And you remember, I've been saying here that I'm looking for a move towards 360, right? We haven't made it all the way down to 355, 350, 360. It's a zone there between 350 and 360. Now, there is no rule that says that we have to make it all the way down to that level. I've explained before how important and fundamentally unlikely it is to break through that level to the downside unless something dramatically changes from the side of the Fed, which I don't think something dramatically will change anytime soon, right? They might change the wording or whatever, but they're not going to make some kind of a dramatic move to the downside having to do with rates. That's something that's extremely unlikely to happen imminently, right? Perhaps I'm chasing my luck for thinking that we might see 350 to 360. Perhaps we'll never make it there, right? Perhaps the low we saw here at 365 is enough. It's not unlikely, right? In any case, in my opinion, there is still the possibility and room for another leg lower towards that area. Now, from a risk-reward perspective, it would still probably be a good long being long against these levels. So that is why I'm also skeptical having to do with USD yen. That's why I'm showing you the 10-year yield, right? Because I think that the 10-year yield has extremely low probability of going below 350 for quite some time, right? So that's why I've started feeling that perhaps I'm pushing my luck with hoping for much more in the front of USD yen to the downside. Anyhow, as I said, I'm going to reassess again on Monday. Let me see what else. Yields and economies can be approximately by quantitative mathematical models bearing unforeseen shocks where LTFC came unstuck in 1997. Yes, I agree with you, Richard. Richard also wrote before, best way to cut inflationary expectations is to cut value added and tariff taxes and encourage more production and productivity to increase the supply of everything. I agree with that. Real wealth is anyhow production and productivity, right? And all the improvements that have come through in our all the improvements we've seen in our way of living is the product of increasing productivity, right? That's, I mean, people that understand economics know that the number one metric for prosperity in an economy is productivity. So I agree with you, Richard, 100%. And encourage a truce in Ukraine-Russia war. That's going to be much harder. Unfortunately, the elected monarchs are not capable of getting us out of the mess of their own making, and that's a problem because it's of their own making. So, of course, by giving cash away while at the same time legislation for lockdowns or businesses, yeah, I agree with more or less with everything you're right. Putting up rates will lead to no growth or way below trend growth for many years, which will make. Now, I kind of disagree with that. I believe that rates should be healthy, and by healthy means not manipulated. I believe that that rates should be left alone to find an equilibrium that is going to depict the real value of money. It's going to make savings and saving, because we talked about productivity before, right? That the number one metric for economics is productivity. The question is, what drives productivity? In most occasions, it's indirectly or directly capital, right? Why? Because capital is being used to either buy, for example, equipment or whatever that increases productivity, or innovate things that increase productivity, right? Question, how do you get capital? Where does capital come from? Answer, savings. The problem with the current rate environment that we've been living under during the past 15 years is that it's an artificially set rate environment, which not only doesn't offer a decent return for somebody to consider saving, but it actually penalizes savings, right? Which is an atrocity, right? So I do think that that we should build, if we build economies on proper base, then these economies should afford having more normal rates. I remind you that if you go back historically and you look at the average rates are a lot higher than what we've gotten used to being, right? So I think that at least having a normal cycle rate when you're in an expansionary period between, let's say, 2% and 5% should be considered healthy, right? And perhaps consider cutting rates somewhat lower very, very temporarily when you actually go into a recession. DXY, and then we have a question about yen crosses. So we already visited USD yen. I'm not going to go over it again. We already saw the DXY, but let me briefly say once again that we're testing this horizontal support resistance area. The 200 daily moving average is just below it. Now, if we break through that, the next downside target is 104.64, that low. Very important level also, because if we actually break through that, then we've also broken the sequence of higher lows, right? we're going to be breaking through a quite important low down here. So that's going to be another bearish nail in the coffin of the dollar. That's going to increase the probability that that was a very important high over there at 114.78. Okay. Now, to satisfy the request from Alan, let's have a look at some of the major yen pairs. Euro yen. Notice how it's retesting again this ascending trend line support. You can clearly see that the momentum of the upside move has stalled, and there is a probability that we might actually see the wheels go off the bus, but not yet, right? It's still holding, it's still consolidating its prior gains, but I definitely have started being a little bit skeptical with what I see. And if you look at the pound yen, you'll notice something rather similar, not exactly the same, right? We had this move higher, brought us to new highs. We had a consolidation lower in what looked like a very nice pennant. So far, so good. We broke through the pennant. So far, so good. And now we're consolidating that. For the time being, that can be interpreted as a bullish sign, right? Somebody can say, okay, here we are. We're creating a little bit of a consolidation, a triangle, or whatever the hell that's going to prove to be, right? And we're going to push higher once again. Yes, and that can actually be the case. You definitely don't want to see a move below 163.15 though, right? Because then the interpretation is going to start being completely different. So pound yen for the time being looks healthier, right? Now having to do with commodity currencies against the yen, here is the Aussie yen, still holding within this ascending channel, still showing like the most recent consolidation is probably a bullish one, right? You see, I already had this drawing up there. You look at the Kiwi yen, you're going to notice that it looks even more bullish. We're testing once again these highs over here while we remain, notice this, in a multi-year ascending channel, right? It's exactly 2.5 years that we've been building this channel. So definitely we need to do a lot more to turn bearish here, right? So for the time being, the vast majority of the yen pairs look more likely to move to the upside than to the downside, right? For the time being. Momentum, though, has clearly stalled. CAD yen, you see a little bit of a different picture, right? I had drawn that little triangle over there. We've broken through it. So, CAD clearly underperforming what we've seen from the side of the Kiwi, for example, right? We've broken through this ascending wedge as well. Next downside target here, 102.20. So a little bit of a different view here. Clearly, if you want to be short the yen, you don't want to do it against the CAD and not the Kiwi, for example, right? You have to choose the best fighter to be on your corner, right? So you want to be short the yen, you're going to short the yen against what is relatively stronger, right? So for example, that would not be the CAD in this case. I think that's it more or less. I mean, we can start going through the NOK, etc. But, I think you get a very good idea by having gone through that. Anyhow, I think we can wrap up the week here, since we know it's a holiday and it's a very slow day. Thank you everybody for being here, and we're going to be back on the horse on Monday, back in action. Hopefully the markets are going to also start getting some more volatility, although I doubt we're going to see much happening by Wednesday. But anyhow, the upcoming week is going to be an interesting week for sure. The beginning of it might not be very interesting, but I do think that the week overall, by the end of it, will have provided quite a lot for us to trade and talk about. So thank you, Cohen. Thank you, Stelios. Thank you everybody for being here, and we'll talk to you again on Monday.